Welcome to Tenor Tech, where I solve the problems you didn't even know you had.
You start by enabling options trading and answering Robinhood's approval questions. This determines what strategies you can use. Next, fund your account or confirm margin buying power so orders won't reject. Then search the underlying ticker and open the options chain to see expirations and strikes. Pay attention to implied volatility and upcoming earnings because those drive premium. Once done, you're ready to choose an expiration and a target strike for the trade you plan to place. Now you construct the trade. Decide why you trade, directional, income, or hedge, so pick buy call, buy put, or a spread accordingly. Then set expiration and strike prices that match your time horizon and risk. Use delta to approximate move sensitivity and theta to gauge time decay. Enter contract quantity and choose limit or market order. Set duration to day or good till canceled. Always preview estimated debit/credit, commissions, and requirement. Make adjustments, then submit when the price matches your plan. After entry, monitor the trade and the Greeks regularly so you know why value changes. Theta eats long option value, while implied volatility shifts premium. Close or roll positions before expiration to lock gains or reduce risk, and avoid assignment surprises on short positions. If you must exercise, do it only when intrinsic value and fees justify it. If an order won't fill, switch to a tighter limit, confirm buying power, or contact Robinhood support. Those steps fix most rejections and execution hiccups.
Thanks for watching. Subscribe to keep your life in tune.